Hello everyone, this is Tyler from Foundation Investing. Let's talk shorting stocks. So the title of this presentation is Everything You Need to Know About Shorting Stocks. So first off, let's answer the question, why should we short stocks in the first place? Well, JP Morgan came out with a fantastic ebook called The Agony and the Ecstasy, which shows just how many companies actually fall quite a bit from their all-time highs and never return. So I've stripped out a few facts here that I'm going to present. If you want to read the whole book, I'm going to put the links below in the description. Using a universe of Russell 3000 companies since 1980, roughly 40% of all stocks have suffered a permanent 70% decline from their peak value. For tech, biotech, and metals and mining, numbers are considerably higher. Those stats are staggering. So permanent loss meaning it comes down and it never returns that higher. You permanently lose 70% on your all-time high in that stock. Recent examples that we have found include GoPro, DDD, the 3D printing company, and Yelp, which have fallen tremendously off the all-time high. Who knows if they're likely to ever return. These could be another one of those stats that have permanent 70% declines. And finally, 40% of all stocks in Russell 3000 had absolute negative returns. That's a lot. That means from 1980 until now, 40% of all stocks lost you money. For large caps, since 1980, over 320 companies have been deleted from the S&P 500 for business distress reasons. That's a lot of turnover considering the index is only 500. So since 1980, over half the index has changed and has become new companies. So where are those rest going? They're getting replaced by the hotter, newer, sexier companies, and those ones are grinding sideways to lower, back out of the limelight. So does this really surprise you? It doesn't surprise me. I know how much survivorship bias persists in our society, which means that we tend to focus on the winners, stuff like Apple, Google, Tesla, Facebook, and we rarely talk about the losers, the things that maybe saw heights in the dot-com era and never returned, and no one pays attention to them anymore. So this is why those stats might seem more surprising to many people. Now let's get into how shorts are different than longs. We know that you can short a lot of stocks. A lot of things are falling. How do we approach them? So there's some structural differences between shorts and longs. You need to understand that the world is levered long. So shorting is playing against what the system's designed to promote. And everyone from institutions to governments to banks to financial advisors to robo-advisors want to see the market go up. They get paid when the market goes up. Their clients make money. They make money. Everyone's more happy. So when you're shorting stocks, you have to know that you're going against that huge tide. It's a structural tailwind tide that's keeping stocks up, and that's going to cause them to trade a little bit differently than things to the long side. There's also cost differences to consider when we're shorting stocks. So for example, borrowing. You have to pay to borrow shares to short, and you can see on brokerages, here I have IB Yield Optimizer, they display those rates. Also the dividend payment, you have to pay that as well when you're short. So there is a cost to carry and hold stocks short, unlike longs where you receive a dividend, you get paid to just hold long stock. Short stock, you have to pay. And there's also regulatory constraints, so you can't short stocks outright in retirement accounts. There are some ways to get around it, like put options and inverse ETFs, but you cannot outright short unless you have a margin account. So now let's talk about tactics and how we can actually trade at the short side, best practices for that. So price action. In general, when stocks go down, they move much differently than when they go up. So technical entry and exit strategies you might have learned to the long side do not carry over to them. This is because of the escalator up, elevator down effect, which means that stocks tend to grind higher and then crash lower. Also, as stocks fall, volatility increases. So this means that counter trend rallies are extremely vicious. These rallies are called short squeezes or bear market rallies. So when you're short stock, you need to prepare for these extreme snapbacks, and you're not going to see as much basing like in longs. So I'm going to show you guys a few examples here. Here's a Canadian bank that we've been shorting. At the beginning of 2016, you can see there was a huge drop from 66 to 56. That's an over 10% drop, and then a subsequent rally that was just as strong before it's starting to roll over again. That's very common in shorts, where you fall and then retrace most of the move before you have the next leg lower. That's what I talk about when I'm talking about short squeeze. Now here's Apple. You can see on the contrary, the action is much different. We go up, kind of base sideways, pop up again, base sideways, and the retraces aren't as swift, fast, and as hard. So what are some tips to combat this difference in price action? First, use wider stop losses. Do not trail as tightly when you're in shorts. You'll easily get knocked out of them. Take some partial profits on the down moves. Since the things are so likely to snap back, it makes sense to take some off the table, book some profits, and get prepared to reload after the short squeeze is over. This keeps you in the trade. It's much more comfortable, and ultimately it will save you a lot of anxiety when you watch all of your short profits evaporate due to a short squeeze. And finally, never short stocks without a stop loss. This is key. You never short a stock without a stop loss. When it gets to your point, you always exit. Many of investors in the 99 era and even in our latest bull market have blown up because they shorted what they thought were overvalued companies, and the things doubled from there. So always respect your stop losses. That's it for shorts. Thanks for listening today. You can check us out on StockTwits, Facebook, Twitter. I have all the links below. We have a pretty cool Facebook group where we talk about global macro and what's going on. And our website is foundationinvesting.com. Thanks for listening, and I'll see you next time.